Are you ready to accelerate your wealth like never before? In this video, we're going to reveal the secrets of the Dividend Snowball method, a powerful strategy that can turbocharge your investments and help you achieve financial freedom faster than you ever thought possible. Don't miss out on this game-changing opportunity. Watch now and start building your wealth snowball today. Welcome back to Simply Money, where we focus on personal finance and investing. In today's video, we're going to be discussing the Dividend Snowball method. So let's dive into the details. Let's start with the basic. Dividend investing is simply investing in stocks or funds that pay dividends. If you're not sure what a dividend is, check out the video link above for a quick overview of dividends and how they work. But basically, dividends are regular payments made by the company to shareholders. So by investing in dividend-paying stocks or funds, you can generate a steady stream of passive income. And that dividend income can be used to pay expenses, to help save toward retirement, or by activating the DRIP, Dividend Reinvestment Plan, to put back into your portfolio. So if you're still saving and working on building your portfolio, make sure you go into your account and set the DRIP, D-R-I-P, Dividend Reinvestment Plan. So when you get a dividend, it automatically buys more of the shares. And we'll talk here in a moment why that's so important and how that grows your portfolio exponentially. So that brings us to part 2, the Dividend Snowball method. The Dividend Snowball method brings investing to the next level. And as I said, it does this by reinvesting the dividends back into the portfolio. The method allows you to buy more shares of the dividend-paying stock, which in turn pays you more dividends. And we're going to look at the math of this here in a moment. And over time, this creates a snowball effect with your dividend income. This is happening as exponential growth is impacting your dividend, all due to the power of compounding. One of my favorite quotes is from Albert Einstein, who calls compounding the 8th wonder of the world and says, "Those who understand it earn it, and those who don't pay it." The Dividend Snowball method takes compounding to the extreme level of creating passive income for you, the investor. So let's look at part 3, how to build the Dividend Snowball. I remember as a kid going out packing some snow and then beginning to roll it, and it got bigger and bigger, so big that I could not move it by myself. I'd get my friends or my brother or my sister to come help me roll it. Then we'd have to roll another one and try to get that on top to make our snowman. But the power, the bigger the snowball got, the more snow it accumulated on every roll. It was growing exponentially to where I couldn't even push it myself. Your dividend payment can work the same way. As you're starting out, you have this small little snowball you're rolling, and you're picking up a little bit of momentum, but before you know it, that snowball has grown to larger and larger proportions, and those payments are continuing to accumulate. So in order to build a successful dividend snowball, follow these steps. 1, start by investing in quality dividend stocks, or as I prefer, index funds, because it automatically diversifies you into various companies. 2, set up the Dividend Reinvestment Plan, the DRIP, in order to automatically reinvest your dividends to buy more of the same stock or fund. 3, stay consistent with your investing and add to it regularly. I like to make it a habit when you get a pay raise or come across extra money, however that happens, a side gig, to take a portion of that and put it toward extra investments, accelerating that snowball even faster. 4th is you want to monitor your portfolio and make adjustments as needed. I don't want you overly adjusting. I don't want you worrying about market trends up and down, but be cautious and watch your investments to make sure that they're still being managed by the company properly. That's why I prefer index funds that do that automatically. It creates diversification immediately, automatically resets and adjusts quarterly, and it washes in and out new stocks as needed based on the methodology that they're using. You can check out the video I've done on what index funds are. I have some links below on other videos I've done on breaking down all the terminology of index funds. If you want to go over those, please see those videos. So those are the 4 steps you want to follow to build the snowball method of dividend growth. There are some things you need to look at. You want to make sure you're diversified. You want to make sure that they have a consistent history of paying dividends. And I like dividend growth funds that not only consistently pay a dividend, but consistently grow the dividend, known as the CAGR, C-A-G-R, which simply stands for compound annual growth rate. How fast or how much are they growing the dividend from year to year? It's great to get a dividend that's steady, but it's even better to get a dividend that's growing, because then your yield on cost is going up, meaning you're making more for the investment that you made. I'll do another video shortly on what a CAGR is, what to look for, and why it's so important and how powerful it can be. So part 4, let's look at an example to kind of bring this all together and see what it looks like in theory mathematically. So let's pretend you start with $500 a month in a growth dividend fund with a 7% CAGR, meaning that dividend is growing by 7% annually. Let's also assume that the starting dividend is 3.5% and the value growth of the fund is growing by 5% annually, meaning the cost of the share is growing by 5%. And I know that seems low, but when you have a CAGR of 7%, you're growing your income and you're buying back in more of those same shares. And I'm going to talk at the end, so stay tuned for why that's so important, buying more shares versus just having exponential growth of the value of the stocks. So with this hypothetical example of $500 a month with a 7% CAGR and a 5% value growth of the stock, or again, as I like to use, index fund, let's see what the value would be at 10, 20, or 30 years. Let's start with 10 years. By investing $500 a month for 10 years, at the end of 10 years, your value of stock, your portfolio, should now be worth around $91,000. But more importantly, your dividend being paid to you annually would be $3,900. But because you've set up your drip, that $3,900 is added into your portfolio, buying more of the same fund. It gets even better. That's the small snowball. If you're young, you're 25, you're 30, you're just beginning, you have time on your side. Let's look at 20 years down the road doing the same $500 a month with the same 7% CAGR and 5% growth rate. Now 10 additional years, you don't double your money. You didn't go from $91,000 to $182,000. At the end of 20 years, your approximate value would be $324,000. And likewise, your dividend payments would be around $17,000 annually. That's fourfold growth on the dividend being paid to you. So think about that for a moment. In 20 years, if you decided to turn the drip off, your portfolio value is at $324,000, continuing to grow at that 5% if you're taking that money out. However, we're playing the long game, and I'm hoping you younger folks are going to look at this for a 30-year plus opportunity to really see the exponential growth. So what would it look like at the end of 30 years? Throw a comment down below what you think the value would be at 30 years with this hypothetical example. So at the end of 30 years in this example, your portfolio would be worth approximately $990,000. That's very impressive. But more impressive would be the dividend payout that you would be receiving annually, which would be approximately $62,500. Now that's how you create passive income with the snowball dividend method. This method allows those reinvestments to grow and to buy even more stocks. Why is this important? Let's look at an example. If I bought just stock A, which grows, and then in 30 years it's worth $990,000, or let's say it's worth $1.2 million. When I go to use that, I can't just generate income. I have to sell the number of stocks I have. If I need money, I need to sell however many shares to equal the amount of money I need. And over time, I'm losing the number of shares that I own. With the dividend snowball method, let's just say round up to $1 million after 30 years, I have $62,500 that I can just turn off the drip and have that income being paid to me, whether it's monthly, quarterly, or annually, depending how the dividend is paid, but coming to me, and I never have to sell a single share of what I have accumulated over those 30 years. So those shares continue to build value, but I'm never selling any of those. That's what you call legacy wealth. That's what you get to leave to your kids and your grandkids, because those shares aren't being sold to sustain your life. The income's being generated and paying you. It's a wonderful opportunity to grow your wealth, to impact your lifestyle, to set yourself up for financial freedom. Now keep in mind, this is a hypothetical example. It could actually be way better than that. I have a dividend index growth fund that I use that has an 11% CAGR and has done extremely well. I don't have 30 years as I'm a little bit older. I will be using that drip much sooner than some of you. For you younger folks, begin to make that commitment now. That small sacrifice today will pay huge dividends. That's where the phrase comes from. It'll pay huge dividends in the future. The dividend snowball method can be your best friend for growth because it not only grows your value, it grows the number of shares that you own, which becomes even more powerful. So start building your wealth today, start your journey toward financial freedom, and look into setting up a dividend snowball method of your own. Do your due diligence. As I always say, do your homework. Look into what you're purchasing. If you're not sure, do more research. If you have money to invest, set it aside until you've done your thorough research. Make sure you don't just jump in because somebody told you to. Don't buy a stock or a fund just because someone recommends it. Do your own homework. It's your money. It's your future. Make sure you're doing your due diligence. Do you have a favorite dividend stock or a dividend fund? Throw it down below. Let us know. Share with the community for others to be able to look into it and do their due diligence. Thanks for joining me today. I appreciate you joining us on Simply Money. If you have an opportunity, hit the like button. Share this with a friend. Share this with somebody you know that may be looking to do some investing. And as always, we'll see you next time on Simply Money.